So friends, today's topic of discussion is capital market and money market. We will be covering the following topics in two parts. In the first part, we will discuss about financial market, capital market and components of capital market. And in part second, we will discuss about money market and components of money market. So let's start with understanding what is financial market. A financial market is referred to space where selling and buying of financial assets and securities take place. It allocates limited resources in the country's economy. It serves as an agent between the saver and the investor by mobilizing capital between them. If we talk about functions of financial market, then financial market mobilizes saving by trading it in the most productive method. It assists in deciding the securities prices by interaction with the investors and depending on the demand and supply in the market. It gives liquidity to tradable assets by facilitating the exchange, as the investors can easily sell their securities and convert assets into cash. Right? And the last is less time consuming and cost effective, as parties do not have to spend extra time and money to find potential clients to deal with the securities. Next topic is classification of financial market. Financial market can be classified into four different categories. First is by maturity of claim. Under this, there are two types of financial market, which are capital market and money market. Capital market is the market where medium and long term financial assets are traded, whereas money market deals with monetary asset and short term funds. Next is by nature of claim. Under this, there are two types of financial market, debt market and equity market. Debt market is a market where fixed bonds and debentures are exchanged between investors, whereas equity market is a place for investors to deal with equity. Next classification of financial market is on the basis of timing of delivery. That means at what time the securities are delivered to the investor. Under this, first is cash market. Cash market is a marketplace where trade is completed in real time. That means on the same day. And future market is a market where the delivery of product are taken in the future specified date. Fine. And the last is bund organizational structure. Under this, first is exchange traded market. Exchange traded market has a centralized system with patterned procedure. Fine. For example, trade of securities that take place on Bombay Stock Exchange and National Stock Exchange are the example of exchange traded market. And the last is over the counter market. Over the counter market has a decentralized organization with customized procedure. So this was all about classification of financial markets. In this video we will discuss about only capital market and money market and their components in detail. Next topic is components of capital market and money market. We have seen that types of financial markets are capital market and money market. And if we talk about components of capital market, then primary market and secondary market are the components of capital market, whereas components of money market are treasury bills, certificate of deposits, commercial papers, repurchase agreements, call money, notice money and term money, and last is bankers acceptance. Fine. Let us understand what is capital market. Capital market is a market for trading of long term investments. That means it is a marketplace for investment that have a lock in period greater than a year or their maturity period is at least more than a year. Fine. And the capital market involves the sale and purchase of both equity and debt instruments, including equity shares, debentures, preference shares, secured premium notes, and zero coupon bonds. And one of the primary function of capital market is providing insurance against market volatility and price risk through derivative trading. And capital market consists of primary market and secondary market. Primary market deals with trade of new issue of stocks and other securities, whereas secondary market deals with exchange of existing or previously issued securities. Now let us learn in detail what is primary market. Primary market is where securities are created. It is in this market that firms sell new stocks, bonds to the public for the first time. An initial public offering or IPOs is an example of primary market. An IPO occurs when a private company issues stock to the public for the first time. Other type of primary market offering for stock include private placement and preferential allotment. Private placement allows companies to sell directly to more significant investors such as hedge fund and banks without making shares publicly available. While preferential allotment offers shares to select investors, usually hedge fund, banks, and mutual funds, at a special price not available to the general public. The securities may be at face value or at a discount premium. In primary market, public issue of securities is made through a prospectus in retail market and there is no physical location. Next is secondary market. The secondary market is where investors buy and sell securities they already own or the securities which are already been issued. A secondary market is a platform wherein the shares of the companies are traded among investors. It means that investors can freely buy and sell shares without the intervention of the issuing company. Income in this market is thus generated through the sale of shares from one investor to the another. Entities that are functional in secondary market include retail investors, advisory service providers and brokers, and financial intermediaries including non-banking financial companies, insurance companies, banks and mutual funds. The instruments traded in secondary market consist of fixed income instrument, variable income instrument and hybrid instrument. Fixed income instruments are primarily debt instruments ensuring a regular form of payment such as interest and the principal is repaid on maturity. Example of fixed income securities are debt, debentures, bonds and preference shares. Variable income instruments. Variable income securities expose investors to higher risk as well as higher reward. Example of variable income instruments are equity and derivatives. Last is hybrid instruments. Two or more different financial instruments are combined to form a hybrid instruments. Convertible debentures serve as an example of hybrid instrument and convertible debenture are available as a loan or debt securities which may be converted into equity share after a predetermined period. Next is difference between primary market and secondary market. First is meaning. A platform that offers security for the first time is the primary market and the market where investors trade already issued securities is known as secondary market. Next is another name. Alternative name for primary market is new issue market, whereas alternative name for secondary market is aftermarket or share market. Next is type of product. Products are limited and mainly include IPOs, that is initial public offering, private placement, preferential allotment and more. And in case of secondary market, many products are available such as shares, warrants, derivatives and more. Next is purchase type. All the purchases in primary market happens directly, that means in between the issuing company and the investor. And in case of secondary market, the issuer company is not involved in the trading, that means exchange take place among the different investors. Fine. Next basis of difference between primary market and secondary market is frequency of selling. In case of primary market, securities can be sold to investors just once, whereas in case of secondary market, the traders can buy and sell the shares as many times as they want. Next is how to identify investment. In case of primary market, investors primarily rely on prospectus and word of mouth publicity. Fine. And in case of secondary market, several tools are available to the investors to help them pick good investments such as price to earning, price to book, price to sales, and more. Next is beneficiary. In case of primary market, the issuing company is the beneficiary, whereas in case of secondary market, the investors are the beneficiary. Next is intermediary. In case of primary market, the underwriters are the intermediary, and in case of secondary market, the brokers are the intermediary. Next is purpose. The purpose of primary market is to help new and existing companies to raise capital for expansion and diversification, whereas secondary market does not provide funding to companies, rather help investors to make money. Next is price. In case of primary market, the company sell the shares to the investor at a fixed price, whereas in case of secondary market, both buy and sell side investors work together finding the best price for the trade. Next is presence. There is no organization setup for the primary market, whereas in case of secondary market, there is a geographical setup and organizational presence. For example, Bombay Stock Exchange and National Stock Exchange, etc. And next is rules and regulation. In case of primary market, the company issuing securities goes through a lot of regulation and diligence, whereas in case of secondary market, investors and brokers need to follow the rules set up by the exchange and the governing agencies, which is Securities Exchange Board of India. So this was all about capital market. Stay tuned for the next part.